Have you ever felt like you're at a crossroads, unsure whether to venture into the bustling casino of high-stakes investments or join the community pool of steady growth? Welcome to the exciting world of finance, where hedge funds and mutual funds vie for your attention and your money. But before you dive headfirst into this complex landscape, let's ask ourselves a pivotal question. Which investment vehicle is right for you? Join us as we unravel the mysteries and nuances of hedge funds versus mutual funds, paving the path to informed financial decision-making. Understanding investments. Picture this. You've got some spare cash burning a hole in your pocket, and you're eager to see it flourish. That's where investing comes in. Investing is like planting seeds of opportunity, nurturing them over time, and reaping the rewards when they blossom into something substantial. Whether it's stocks, bonds, or real estate, investments have the potential to grow your wealth exponentially. Types of investments. The investment world is a smorgasbord of opportunities, offering something for every palate. Stocks offer ownership in thriving companies, while bonds provide a steady stream of income through loans to governments or corporations. Real estate tantalizes with the promise of appreciation and rental income. And let's not forget about derivatives, the exotic spices of the investment buffet. With such a wide array of choices, there's bound to be something to satisfy every investor's appetite. Mutual funds. Let's start with mutual funds. Picture this. You and a group of friends pool your money together to buy a pizza. Each of you owns a slice, and the toppings represent different assets, like stocks, bonds, or other securities. Now replace that pizza with a mutual fund, and you've got the basic idea. Mutual funds are investment vehicles that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other securities, managed by professional fund managers. One of the key features of mutual funds is their accessibility to retail investors, meaning anyone with as little as a few $100s can invest in a mutual fund and gain exposure to a diversified portfolio. Benefits of mutual funds. Mutual funds present a plethora of advantages that make them an attractive investment option for a wide range of investors. Firstly, mutual funds offer unparalleled diversification, allowing investors to spread their risk across a broad portfolio of assets, including stocks, bonds, and other securities. This diversification helps mitigate the impact of market fluctuations on individual holdings, enhancing portfolio stability and reducing overall risk exposure. Moreover, mutual funds provide access to professional management expertise, with seasoned fund managers making informed investment decisions on behalf of investors. These managers conduct in-depth research, analyze market trends, and adjust the fund's holdings accordingly, saving investors time and effort while potentially maximizing returns. Additionally, mutual funds are highly accessible, offering investors the opportunity to start investing with relatively low initial capital requirements. This accessibility democratizes investing, allowing individuals of varying financial means to participate in the financial markets and pursue their investment goals. Drawbacks of mutual funds. Despite their numerous advantages, mutual funds also come with certain drawbacks that investors should consider. Firstly, mutual funds are subject to management fees and expenses, which can eat into investors' returns over time. These fees typically include management fees, which compensate the fund manager for their services, as well as administrative expenses and operating costs associated with running the fund. Moreover, mutual funds may suffer from limited flexibility, as investors have little control over the fund's investment decisions. While professional management can be advantageous, it also means that investors must rely on the fund manager's judgment and expertise, which may not always align with their individual investment objectives or risk tolerance. Additionally, mutual funds may be subject to taxation, with investors liable for capital gains, taxes on any profits generated by the fund's holdings. Depending on the investor's tax situation and the fund's distribution policy, these taxes can erode returns and reduce the overall effectiveness of the investment strategy. Hedge funds. Now, let's shift our focus to hedge funds. Unlike mutual funds, which are accessible to the general public, hedge funds are typically open only to accredited investors, such as high net worth individuals and institutions. This exclusivity stems from the fact that hedge funds employ more sophisticated investment strategies and often take on higher levels of risk. Hedge funds are managed by professional investment managers who aim to generate absolute returns regardless of market conditions. Unlike mutual funds, which are often benchmarked against a specific index, hedge funds have more flexibility in their investment approach and can employ a wide range of strategies, including long-short equity, global macro, event-driven, and quantitative trading, among others. Benefits of hedge funds. Diving into the realm of hedge funds unveils a treasure trove of potential benefits for the daring investor. Firstly, hedge funds often boast the allure of higher returns compared to traditional investments. Their dynamic strategies and nimble approach to market fluctuations allow them to seize opportunities that may elude conventional funds, potentially delivering substantial profits even in volatile conditions. Additionally, hedge funds offer unparalleled diversification beyond traditional asset classes. With the ability to invest in a wide array of instruments, including derivatives, commodities, and alternative assets like private equity, hedge funds provide a unique avenue for spreading risk and enhancing portfolio resilience. Moreover, hedge funds grant access to exclusive investment opportunities typically reserved for institutional investors or the ultra-wealthy. From early-stage ventures to distressed assets, hedge funds offer a backstage pass to lucrative deals that can significantly bolster your investment portfolio. Furthermore, the flexibility inherent in hedge fund strategies enables managers to adapt swiftly to changing market dynamics, capitalizing on emerging trends and mitigating risks more effectively. For those seeking to amplify their investment returns and diversify their portfolio beyond traditional boundaries, hedge funds represent a compelling option worth exploring. Drawbacks of hedge funds. However, venturing into the realm of hedge funds comes with its fair share of caveats and potential pitfalls. Firstly, the lofty pursuit of higher returns often entails navigating treacherous waters fraught with increased risk. The sophisticated strategies employed by hedge funds, including leveraging and short selling, can amplify losses just as easily as they augment gains, leading to significant volatility and potential capital erosion. Moreover, the opacity surrounding hedge fund operations and the limited regulatory oversight raise concerns regarding transparency and accountability. Additionally, hedge funds are notorious for their exorbitant fees, which can significantly erode returns over time. From management fees and performance fees to administrative expenses, the cost of investing in hedge funds can be prohibitive, particularly for smaller investors. Furthermore, the illiquidity inherent in many hedge fund structures presents a formidable challenge, as lockup periods and redemption restrictions limit investors' ability to access their capital when needed. This lack of liquidity can prove especially detrimental during periods of financial distress or unforeseen emergencies, leaving investors vulnerable to liquidity crunches and potential losses. In summary, while hedge funds offer the promise of enhanced returns and diversification, they also entail heightened risk, exorbitant fees, and limited liquidity, underscoring the importance of thorough due diligence and careful consideration before venturing into this high-stakes arena, choosing between hedge funds and mutual funds. So, which path will you choose? For those who thrive on excitement and are comfortable with the prospect of substantial risk, hedge funds offer an enticing opportunity to potentially reap significant rewards. With their dynamic strategies and exclusive access to unconventional investments, hedge funds provide a thrilling ride for high-net-worth individuals seeking to maximize returns. On the other hand, if you prefer a more conservative approach to investing, mutual funds present a compelling alternative. With their diversified portfolios, professional management, and lower barriers to entry, mutual funds offer a safer haven for investors looking to navigate the market with caution. Whether your goal is capital preservation, steady income, or long-term growth, mutual funds provide a reliable framework for achieving your financial objectives. Ultimately, the decision boils down to your risk tolerance, financial goals, and investment horizon. And remember, seeking guidance from a trusted financial advisor can provide invaluable insight and help you navigate the complex terrain of investment with confidence and clarity. The choice between hedge funds and mutual funds is not one to be taken lightly. Each offers its own set of advantages and drawbacks, catering to different investor profiles and risk appetites. By understanding the intricacies of both investment vehicles, you can chart a course towards financial success tailored to your unique circumstances. If you found this video informative, then don't forget to hit that like button and subscribe to our channel for more amazing content. Thanks for watching.